Have you ever wondered what Bitcoin really is or how digital money is completely reshaping the way we spend, save, and invest? Over the past decade and a half, cryptocurrencies have become one of the most revolutionary changes in how we understand money itself. From Bitcoin's quiet arrival in 2009 to the rapid rise of central bank digital currencies, or CBDCs, today the world of finance has never looked so different. To really understand what's going on, we need to unpack how cryptocurrencies work, why they were created, what makes them powerful, and the risks and regulations shaping their future. Let's dive in. Imagine it's 2008. The global financial system is in chaos. Banks are collapsing, trust is fading, and people are wondering if the traditional money system is broken. Then, out of nowhere, someone named Satoshi Nakamoto publishes a paper online, a white paper describing something called Bitcoin. It was a radical idea, a kind of digital cash that didn't need banks or governments to move money between people. You could send value anywhere in the world directly, securely, and privately. Think of it like emailing money, but without any company like PayPal or Visa sitting in the middle. That's the magic of Bitcoin. It was designed to be stateless money, meaning it didn't belong to any country and no one could control it. The technology behind it? Blockchain. How blockchain keeps Bitcoin. Honest? At its core, blockchain is a public digital ledger, kind of like a shared Google sheet that everyone can see, but no one can secretly edit. Every time someone sends Bitcoin, that transaction is recorded in a new block. Each block links securely to the one before it, forming a chain. Hence, blockchain. Once a transaction is recorded, it's there forever. It can't be erased or changed, which is why it's called immutable, meaning unchangeable. But how does this ledger stay secure without a bank? It's because of thousands of computers around the world called nodes that all agree on what's true. These computers verify transactions through a process called mining. Mining is the way Bitcoin transactions are verified and added to the blockchain. Picture this: thousands of computers racing to solve a really hard math puzzle. The first one to solve it gets to add the next block of transactions to the blockchain and earn some new Bitcoin as a reward. That's why people call it mining, just like digging for gold. Except the pickaxe is a powerful computer. This process also controls Bitcoin's supply. There will only ever be 21 million Bitcoins. That limited supply is what gives it scarcity, like gold in the digital age. In fact, many investors call Bitcoin digital gold because it's scarce, decentralized, and can act as a hedge against inflation. Bitcoin opened the door, but soon after, others started experimenting with new ideas. Enter the altcoins, or alternative coins. These are other cryptocurrencies inspired by Bitcoin, but built for different purposes. For example, Litecoin was created for faster payments. Ethereum introduced smart contracts, allowing developers to build decentralized apps, called dApps, directly on the blockchain. Cardano, Solana, and Polkadot each bring new innovations like faster speeds or more efficient systems. Think of Bitcoin as the Model T, the first car that changed everything, and Ethereum as the Tesla that brought software and automation to the ride. Now here's the big question. If there's no central bank, how do these systems agree on what's true? That's where consensus mechanisms come in, the rules that help everyone stay honest. The two main ones are: used by Bitcoin, this system makes miners solve cryptographic puzzles to confirm transactions. It's extremely secure, but it consumes a lot of energy. You can think of it like thousands of people racing to unlock a safe. Whoever gets the code right first wins, but it takes tons of effort. This newer method, used by Ethereum 2.0, replaces mining with staking. Here, people lock up some of their coins as collateral. The more they stake, the more likely they are to be chosen to validate transactions. It's kind of like owning stock in the network. You earn rewards for helping secure it. There are also hybrid systems like delegated proof of stake, DPoS, and proof of authority, POA, each balancing speed, energy efficiency, and security in different ways. What types of cryptocurrencies exist? Not all digital coins are created equal. In fact, they fall into several key categories. Payment coins, used as digital money. Examples: Bitcoin, Litecoin, smart contract platforms. These support apps and smart contracts. Examples: Ethereum, Solana, Cardano. Stablecoins, pegged to traditional money like the US dollar to avoid volatility. Examples: USDT, USDC. Privacy coins, focus on anonymity. Examples: Monero, Zcash. Utility tokens, give access to services or discounts within a platform. Example: Binance Coin, BNB. Governance tokens, allow holders to vote on project decisions. Example: UNI from Uniswap. Each one plays a unique role in the expanding crypto ecosystem, from powering decentralized apps to reshaping financial markets. Why cryptocurrencies matter. So, why all the hype? Cryptocurrencies offer advantages that traditional money just can't match. Decentralization. No need for banks or middlemen. You control your money. Lower fees. Sending money across borders can be faster and cheaper than using banks. Financial inclusion. People in areas without banks can still join the global economy. Transparency. Every transaction is verifiable on the blockchain. Programmable money. Smart contracts make it possible for money to move itself automatically when conditions are met. It's like going from mailing letters to using instant messaging. Once you experience the speed and control, there's no going back. Like any powerful technology, cryptocurrencies have their downsides. Volatility. Prices can swing wildly in a single day. What's worth $1,000 today could be $800 tomorrow, or $1,200. Regulatory uncertainty. Governments are still figuring out how to handle crypto. Some embrace it, others ban it. Security risks. While blockchain itself is secure, crypto exchanges and wallets can be hacked. Criminal use. Because of anonymity, some use crypto for money laundering or illegal trades. Environmental concerns. Mining, especially Bitcoin's proof of work, uses massive amounts of electricity. Think of it like the early days of the internet, full of innovation, but also risk, scams, and wild speculation. One of the biggest breakthroughs crypto has sparked is DeFi, or decentralized finance. Imagine a world where you can borrow, lend, trade, and earn interest all without a bank. That's DeFi. Instead of paperwork and approval from a banker, smart contracts handle everything automatically. Platforms like Aave, Compound, and Uniswap let people earn interest, take loans, and swap tokens instantly with no middleman. It's like replacing the entire financial system with open-source software. Another fascinating concept is tokenization, where real-world assets are represented as digital tokens on a blockchain. For example, imagine owning a fraction of a luxury apartment in New York, not by buying the whole property, but by buying a digital token representing 1% of it. That's tokenization. It makes assets like art, real estate, or even company shares more accessible and liquid. It's like splitting a Picasso painting into tiny digital pieces so anyone can own a part of it. While most cryptocurrencies are decentralized, many governments are developing their own digital currencies called Central Bank Digital Currencies, CBDCs. These are digital versions of national money like a digital dollar or digital yuan, fully controlled by central banks. There are two main types. Retail CBDCs, for everyday use by the public, like digital cash in your phone wallet. Wholesale CBDCs, used by banks for large-scale transfers and settlements. Countries like China, digital yuan, Sweden, e-krona, and the Bahamas, sand dollar, are already testing or using them. CBDCs could make payments faster, reduce transaction costs, and improve access to financial systems, especially for people without bank accounts. But there are also concerns mainly around privacy and control. If every digital transaction is traceable by a central authority, what happens to financial freedom? It's a balance between innovation and oversight, and the debate is far from over. Governments worldwide are scrambling to figure out how to regulate crypto, not too much to crush innovation, but enough to protect investors and stop fraud. Regulations vary. Crypto-friendly countries like Switzerland and Singapore have clear supportive frameworks. Restrictive countries like China have banned crypto trading and mining. Cryptocurrencies started as a niche experiment, a digital rebellion against traditional finance. But today, they're reshaping economies, inspiring innovation, and forcing us to rethink what money even is. From Bitcoin's digital gold concept to CBDCs run by central banks, we're watching two worlds, decentralized and traditional, slowly collide and blend. Whether you're a believer, a skeptic, or just curious, one thing's clear. Digital money is here to stay. And understanding how it works might just be as important as understanding the internet was 30 years ago. If you want to stay updated on the world of cryptocurrencies, digital money, and financial innovation, subscribe now and turn on notifications so you never miss an exciting video